हेलो एवरीबॉडी। तो आज हम लेकर आए हैं अ, एक नया सेशन ऑप्शन कॉल एंड ऑप्शन पर बेस्ड. So if as you can see here, you have an Excel sheet of few stocks like GAIL, CIL, SBI. They all have their share price in the same range, about in the same range. So what is a call option? Call option is a right to buy, right? But it's an optional right, because um, I don't have an obligation to buy. If suppose, for example, the share price, which is the underlying asset on which this call option price is trading in the market, is 96.65 for GAIL stock, and I have made a deal that I will uh, buy this share at 100, right, on 25 6 2020. So if I exercise this payoff, if I exercise this, um, then my payoff is negative, because today the market price is 96.65, and if the same uh, you know uh, stock rises to 100, and I say that I will buy this at 100 on a particular date, then this gives me an obvious loss, right? But in that case, if it reaches 100, I'm not going to buy that share, right? So my payoff will be zero. Okay, instead of minus, I will have a negative payoff, but I have already paid a premium of 4.5 on buying this call option. So that will be my negative payoff. And then we have, suppose the share price becomes 90, as in this case out here. So you will have uh, a positive payoff. That's why you will exercise this option, and you have paid a premium of 2.7, so that will become 3.95 as positive net positive profit that you're going to make. So what I'm going to do, and similar is true for Coal India Limited and SBI also. So what I'm going to do here, to make point more clear, I'll insert few uh, more rows, and I will uh, I will put some more prices. So let us say my my strike price is or the asset price today. So let us say that the stock price at the time of expiry of this call option becomes 120, then it becomes 130, then it becomes 150. Let us analyze this situation, and I have uh, made this deal at 100, right? I have made this deal at 100, and for 100 the option premium, as we have seen above, 4.5, right? So let us put it all 4.5. Okay, and let the date be like that only. We are not going to change the date here also. Okay, so you see that the net payoff keeps on increasing as the share price keeps going up. My payoff kept increasing And if I make it say 145, then this is the price range. I'll take you to the graph also, but let me first introduce another interesting variation into it. That is when the share price drops significantly. So let us say the share price becomes first 90, first becomes 85, then it becomes 90, then it becomes 95 before, reaching that 120, right? And when we do fill this up, let us see what kind of results we get. Okay, let us drag that down, and this is here. So obviously all these options where the share price has fallen are not going to be exercised by the call option buyer, but you have paid the premium of say 4.5, 4.5, so that 4.5 will remain your loss. Now what you can see from this graph, let me drag it here. So this is the graph now. I need to erase the other share prices from this. Okay, okay, this should do. This should do. So if you see the graph out here, so the pink line is the net payoff call option buyer, right? So this net payoff, so underlying price is 100. So your net payoff peaks for 145. So this 145 is here. We are talking about this only. So the net payoff, as you can see from here, if the share price is 85, right? If the share price is 85, then you have negative 4.5, negative 4.5, right? So as the share price comes close to say 100, as the share price comes close to 100, now if I make, wait, let me make these all 100, because then only it makes better sense, right? So now you see at as soon as the asset price is equal to my strike price, after that, when the asset price goes beyond my strike price, I keep deriving more and more profit. So you do not have to see this part, because this is for other stock. For the stock that we are talking about at the moment, you are concerned. Let me share only that part of the screen if it is possible. Let me further take it right here. So this is a typical graph of a you know uh, of a stock. So till the time you break even, you are making losses. This pink line is showing that you are making losses. Okay, as soon as you have asset price more than the strike price, you start making profits. Okay, similar is true for the put option. So put option is an option to sell, right? So suppose 97.1 is the present price of my Gale stock. I fear that it will fall further. I say that I have the right to sell this stock at 95. Fine. And if I exercise this option, since the present asset price is 97.1 at which I acquire this and I sell it at 95, so I'm losing 2.1 on this transaction. But I will not exercise this in this case. I'll keep holding the stock with me, right? And then my payoff is zero, but I have paid some premium, so as option price, so that will be my loss. As soon as, now here also let me introduce, for example, here only, let us say I introduce uh, different stock prices, right? And then the picture will be pretty much clear. Okay, so let us say that my 95 remains as it is, the deal that I have made, and that 4.8 is the option price that also remains as it is for this stock. Now instead of it's say rises to 100, okay, it rises to 120, but then it can fall also. So let us see that particular thing, right? Okay, and let us drag them down to see the shape of the curve now. Okay, now you see this curve. Okay, and we are interested mm, okay, let us see, we are interested only, and let me delete them so that they do not impact, and let us be concerned with the chart area till this point only, so here also you see the same thing. So my until my asset price falls to 90, because I bought this option at 4.8 at rupees 95. So if I exercise it, then I am making a slight profit of 0.2, right? So that is the point at which about I break even. And if it falls, the share price falls further, then you see the pink graph is going up and up and up, right? So a typical graph will look like this of a call option, or it's a graph between the payoff and the price of the underlying asset, right? So as the stock price falls, in this particular case, as the stock price falls, you will have a gain in this case, and in case of call option, as the stock price rises, you will have a gain. Okay, does that make sense? Okay, thank you for watching.